Q1 earnings biggest week is coming to a close, and the way that this market will end is going to be important. Hello, ladies and gentlemen, and welcome back to the Daily Show where we talk about stocks, commodities, and cryptos. Today, we deep dive into valuations after Amazon earnings. It was up a lot, and then suddenly it was back down all the way to where it started, and that is based on future projections that are starting to look a little bit scary. But we also need to look underneath the hood, and we're discussing central bank liquidity because it's showing us that things are continuing to dry up. What does this mean for markets moving forward, and whether we can even trust this rally that happened over the last 24 hours? Let's take a look right now underneath the hood. Well, welcome back everyone to the Daily Show where we talk about markets around the world. If it's your first time here, welcome to the community. Subscribe, smash that like button if you find value in today's video, which I'm sure you will. And of course, join us for macro, data, lead indicators, and the hottest charts right now at the key levels. So let's talk about Amazon Web Services. It looks like the growth rate is declining. This is one of the most important aspects to the Amazon kind of overall business. And the CEO and CFOs basically talked about the idea that the Q2 is starting to weaken. And we're going to see it in a stock like Amazon straight away because, of course, it's consumer discretionary as well. Amazon Web Services, people are optimizing and lowering their costs, and it looks like the advent of purchasing cheap stuff is coming back. That means people are starting to tighten up across the board. Now, speaking of tightening, let's have a look at central bank policies. So we know that basically the stock market should be considered the central bank market nowadays, because when we have quantitative easing, markets will go up, especially big tech. And when we have tightening, that means there's a cause for concern. And in recent weeks, since the Silicon Valley kind of crisis, we know that we've seen a huge injection followed by tapering. I'm just updating this chart to show you the tapering continues. And I've also gone and posted over on our Twitter, follow at FX Evolution, links in the description down below, our own custom chart of central bank policies around the world. And what you'll notice here is that basically it's starting to show some worrying signs. A big drop off over the last couple of days of trade session, and this usually precurses some problems in the market. And it is generally delayed. Let's take a look at some of the examples of this. Here we saw a huge spike. You can see what happens to the market over that next period. Here we see a huge spike. You can see what happens to the market over that period. Now, when this turns, however, we also tend to get a move. Drop, markets hold in a pattern, all of a sudden they drop off. And what have we just seen? A new drop in this potential central bank kind of policy liquidity. So effectively the markets look like they're rallying up, but the support is certainly dwindling across the board. To make matters worse, we've got some PE ratios here as well that don't tend to make sense. Things like Microsoft, my favorite stock, is sitting at 33. We'll look at that later. Apple's sitting at 28.61. Nvidia's sitting at 156.26. It reminds me a little bit of 2020 all over again. But why is that? Well, it's not actually the current PE ratios that are generally used. It's forward PE ratios. And I do think a lot of economists are not pricing in anything to do with risk in these markets. And I think that's coming through very clearly when you look at the forward PEs of some of these stocks. Let's talk about smart money inflow versus dumb money inflow. Smart money started buying the dip the other day. We saw a little bit of a switch. It's too early to tell whether this is actually a turn. I doubt it is. But you can see dumb money has dropped a little bit here. And this is what happens. Dumb money tends to drive in when they get confident, but when they get scared a little bit, when the fear starts to go back up, actually less people buy the dip. They tend to buy the dip within a very tight range, usually a coiling style market. We'll talk more about that psychology later on as we look at the S&P 500 in more detail to how this whole thing is playing out so far. When we look at fear and greed index, we notice that it's sitting at 59. It's up about, I think it's like 7 or 9 points over the last 24 hours. And that's due to a very large spike, of course, in trade volume, where we saw a lot of players. Looks like they came back into the market, but we'll watch that later on. If you're an investor, is this time to go, whoa, I need to FOMO in? Historically, no. Money market fund assets are still on the rise. That usually means that we haven't necessarily seen bottoms yet in markets. And we tend to look for these types of things to really show us the key signs. We want money market funds to drop off. We will be following that throughout 2023 into 24. So let's discuss now a couple of big names, and we'll start off here with Microsoft. It's my favorite stock in the market. I've said this for a long time now, and it isn't actually very cheap. So you can see here the earnings, and then you can see the valuations. Now, it's not like they're not beating expectations and making up what they need to do, but if you look here at the valuations, we're back at PE ratios that are sitting around 33. Now, that takes us into the heights of 2020, 2021, and what you might notice about the EPS is the EPS actually did rise with that. I do think that on the surface here, it looks like a lot of these big tech stocks are expensive. Here is Apple. Again, we saw an incredible rise in earnings per share, then a lot of stagnation, possibly even drop-offs, yet look at the valuations. This market is not being driven by true valuation, and there's absolutely no reason to believe that ERP is being considered either, which is equity risk premium. So basically, this is a double-edged sword on the markets. And if you believe the Fed is trying to cause a mild recession or a recession in the markets, generally speaking, it's not really now the time to have FOMO for these big tech stocks at current valuations. Let me know, though, what you think in the comments down below. Let's move over now to earnings season. Of course, we've only got one really major one left, which is Chevron, expected to move about 4%. Amazon technically lived up to its name, big moves in Amazon, Intel, etc. with their earnings reports, but Amazon dropped it straight after they came out with that future report. And that could show us a bit of an insight into what the markets are doing right now. Yes, this earnings season is winning on big tech, but it looks like Q2 is starting to look forecasted to be not as good, and slowdowns could be across the board. Again, starting to put pressure on those valuations, you would think, if those shrinkages do occur. Let's talk about the last 24 hours in markets. Communications was up the most. Why? Well, it was Meta. Facebook basically jumped a lot. There was no real defensive action by the markets, which I think is something we usually would be looking for. So you didn't see utilities or staples coming up. It was pretty much just communications, and XLE, which is probably my weakest market sector at the moment, was only up 0.36. Let's move over to the last 5 days. Because of Meta's huge meteoric rise, we've seen 3.2% on XLC. Staples still remain up high, and then we've got utilities and healthcare in the middling ground. So again, defensives and tech, they're really the things that are holding this market up. It is not the other sectors. So this is a tale of two markets right now, not just one. It's literally two, and it's not looking as good as it has been over a little while. So let's make this show a little bit faster so we can get into the technical analysis, and we'll jump straight into the charts. And I want to bring up a couple of points. The first point is RSP. Now, RSP is the equal weight ETF of the S&P 500. Basically, it eliminates the tech and smooths it through all of the economy or all of the overall sectors. And you'll notice here that, yes, we did see a nice rise. Perfect. However, it's not like it's making a new high, and we've still got a high, a low, a higher high, and a lower low. So it's expected that rallies should be met by sell demand. And this will make more sense when we look at the S&P 500 soon in this video. Let's move over to consumer discretionary versus staples. Now, what this is it's basically the American consumer. That's 1/3 of the US economy. If the American consumer is healthy, XLY should be beating staples. If the American consumer is unhealthy, then we see what we've kind of been seeing recently, which is a drop off of consumer discretionary versus staples. And if we go back through history and you look at the daily here, you can see the times that are great, a lot of the time over the last decade, and then you can see the times that are lackluster. And what we're looking at this stage is still a decline across the board here, which shows us that we should be cautious when looking at these markets over the medium to long term for now. Okay, I'm always an optimist in these markets, don't get me wrong. I don't think we're going to some Great Depression apocalypse, but what I do think is that valuations don't make that much sense. The upside, based on every stat that we've seen over the last couple of months, have really said, more specifically the last month since March, have really started to point out that we aren't looking at an extremely good upside, and the risks are not necessarily worth the reward when going into markets on the medium long at this stage. Let's move over to the VIX. The VIX dropped off considerably. This is being suppressed by 0 DTEs. We will do a special on that, I believe, this weekend. So we'll talk about that. Make sure to subscribe for it. When we move over to the Russell 3000, you can see that even this rally was actually made up of even less stocks than usual. So this is the breadth down here. Look at that. Only 38% of stocks are above the 200 at the moment. And if I actually make a modification to this, which I guess we could do now, and we select the 50, so we'll put that there, you can see here only 32% are above the 50. So this is a horror show in terms of breadth. It's not every single one of the stocks coming up. It's only a few. And if you actually looked at the Russell on something like a 2 hour, I wouldn't blame you for thinking this could be a head and shoulders pattern. Here's the left shoulder, here's the head, here's the right shoulder, there's the neckline, and all of a sudden we go down. Now, generally speaking, when you're doing something like that, you want to proof these markets. And what that means is that we take the length and we see whether it proofs into another level of demand or support. And in this case, it does. So it makes some technical sense that something like this could be occurring. But yeah, it's not good for the Russell 3000 at this stage. The breadth is bad, and it shows you that it is really a market that is being only held up by big tech. As we see big tech's earnings come through, and then that kind of hype and excitement dies off, what happens? Do we just see that kind of sell-off that occurs after that? Just like a bit of a weakness after earnings. You know, once the fund's gone, then all of a sudden the reality starts to hit. Let's move over to copper. Copper did make a new low. However, it failed to close below that level. And copper may be stabilizing for now. Now, if you're new to the channel, Dr. Copper is a great read on the economy, and we've been using this. And I still think copper is going to be quite weak. However, I wouldn't be surprised at all for it to find a little bit of a rally before dropping off. And next level, if we do close underneath this level, 3.823, then we should be moving towards the 3.73s kind of fairly soon. So again, copper weekly close will be important. We'll follow this up on the weekend video, and it still looks quite weak. What about bonds? Well, high yield bonds, they came with the market a little bit, but not to a great degree, only up 0.33%. So high yield bonds still trapped within this zone. If high yields go up a lot and the stock market is going up, then usually that's pretty good and pretty healthy. If high yields go down and the stock market's going up, that is not good for stocks, and usually you need to be cautious. So we use this as a bit of an indicator, and it's certainly showing us some things. If we move over to treasuries, they had a bad day. We know the stats for treasuries, which we've shown a few times this week, are not that positive for the next coming 3 weeks to 4 weeks due to debt ceiling as well and everything that's going on there. I'm still pretty positive on treasuries. However, I can see why, with yields going up, with the US 2-year, 10-year, etc., actually starting to stabilize a little bit, that's putting some pressure on the treasury side, plus the debt ceiling shenanigans that are going on right now. So be a little bit careful there, but treasuries I'm still positive on over the medium long. Let's move over to the dollar index. It found some buyers. We can see it rallied, it dropped, it rallied, and then it kind of sat in the middle. I'm pretty neutral on the dollar here. I mean, if I had to, I'd probably go bullish on these points if I had to, just because of the wicks. But the trend overall is still negative. It's pretty oversold. If you go to a weekly, it really points out how oversold this market is, and you can see why it's stabilizing here. But I would say it's a tough time to trade dollar. It's more likely stuck in a range, and we haven't seen it breach anything like these downward trend lines or, of course, new lows yet. So that's not as easy. What was easy, though, was gold. So for anyone that was in the private community, we were doing a live stream yesterday, and we found ourselves at this level. Then we saw the advanced GDP numbers, which came in a bit soft. And overall, gold was an excellent trade. This was a great short here. Congratulations if you took it. Fantastic into the trend line. That's exactly where it went. I still think gold is weak, and I wouldn't be surprised at all to see gold a little bit lower. And at this point, you know, you can look at it here on the daily. We've got that long leg doji, the high, the low, the open, and the close. It's putting a lot of trend line pressure on. But yeah, I think that probably gold continues to float down. I wouldn't be surprised at all to see it back at something like a 1956 over the next coming sessions. Would I short it here? Probably not as much as I would have up here. But look, this was an exceptional level and certainly worthwhile studying and further understanding why it was there. You can see I've got heavily traded zone for a reason. It's a key level. And that heavily traded zone concept is going to come up again for the S&P 500 very soon. Let's move over to natural gas. Nothing new here. Still looking for it to fill this gap. No new moves, so we won't talk about it too much. Still remains relatively bullish from these lows. Let's talk about oil. Oil didn't drop anymore. Again, rallies should be met by sell demand at this stage. but there's very little trade on oil. And I still favor more the energy stocks to the short side than oil itself. And you can see that was one of the worst sector performances over the last 24 hours, only up 0.36% in comparison to some of the other markets that were up a lot more. And you will notice that gap up, gap down, build of a position, 61.8 fib. Still not an area, not a sector I like right now. Let's move over to Tesla. Now, it found some buyers, but are they strong enough? I don't think so. Again, it rallied 4.19%. That looks great on the surface. The whole market rallied, though, until it gets above this level here, which is 166 basically. I'm not really thinking Tesla's necessarily long. Rallies should still be met by sell demand. And we're looking for that gap fill, which is around the 145, 146, which obviously was left over from this huge rally. You can see it's a 61.8 fib, gap fill in general. And, just realistically, there's not much to like about this chart right now. We've maintained that concept for a little while, and consumer discretionary just doesn't look that strong. It looks like the American consumer is starting to slow down based on Amazon's report and other things. So I'm just going to write this in now and have a look. I think Amazon's stock, it ended up down after hours 2%. So let's just quickly read out some numbers here. Earnings announcement came out and Amazon went to 122.9. Now, what you might notice is 122 is a beautiful secondary resistance. So these are the two areas that we thought Amazon would get to if it was to go bullish. And it just shows you why if you set targets in those levels, and obviously options market, well, that would have been a bit of a pain. You would have had to close it after hours. But yeah, basically these are the kind of levels that you expect it to go to. Then came the earnings. So it went like this. Then came the forecast, and then boom, all the way back down, and it ended up at 107.53. So we still have a chance of holding this trend line. Remember, that was after hours action. So if we go over to the weekly here, there's still a real chance of this trend line being supported and, in fact, consumer discretionary being weak into Big Apple earnings next week as well. And I think Apple is the one that's in focus now. The weekly here is the only trend line we actually have outside of Amazon, I guess, that is actually showing us that there is still a chance that bears really want to take control. Every single rally in 22 was met by sells around this area. This is where the weekly sits at the time of this recording. If we get a bearish day, all of a sudden Amazon's back underneath, and we have potentially 2 weeks that look like this coming into earnings. Well, if we get the follow through, you know what's happened. Wall Street started dumping into retail traders, and that will probably solidify as well that the bears are in control. So I think Apple is one to watch over the next week. And you'll notice that coming into the Friday session, it just went above. Yes, it closed, which is usually a pretty good sign for further. Well, this isn't actually closed on the weekly. Let's have a look at the daily here. There we go. Yes, it closed up here, but it's close to those expected weekly options highs. So I wouldn't be surprised at all to see some Apple weakness over the next 24 hours. Let's find out whether we get it. Move over to XJO. Australian market still looks weak. Made the new lower low. Rally should be met by sell demand. This is pretty much across most of the indices. I know it's hard to see right now, but these are just playing the stats. If you see these types of reads, generally speaking, rally should be met by sell demand. And even with the S&P, it's exactly where we expected it to be after it got through 40.94. And we'll talk about that soon. So XJO looks kind of weak. Let's have a look at the German market here and the European markets. Again, still sideways action. Nothing new coming out of this. Is this accumulation or is this distribution? Well, we don't have an inkling just yet. 2-hour chart doesn't help us too much either. So I've left the DAX off for a few days for that kind of reason. There's nothing much we can go off. Let's look at the weekly now on Russell 2000. So the weekly on the Russell 2000, it's been very bad. And it's been selling off, and then suddenly it found some ramp. Let's use the 2000 futures to kind of understand it better. This is actually a little bit of a potential trap here for traders. So basically we see there's supply here. The markets came straight into that supply, and they tapped it already once before. So we know they respect this supply. It's the most traded zone. If Russell 2000 is going to find some weakness, technically it's going to be around this area here. And this was, a pretty good bull buy. I mean, if you saw that and you saw it ramping through, especially once it engulfed back above, it would have been an okay day trade. Overall, though, I think we're at the critical zone for the Russell, and it happens to be the critical zone for all of these indices. And they're different critical zones, but they all have the same idea. Let's look at the Qs. Now, on the surface of it, the Qs are just back to the highs. Daily close is very similar to the other daily closes. It all looks pretty good. It's left behind now quite a few gaps. So actually, we've got gaps and gaps and gaps. So we can pop them up here. Probably strengthens the chance that the bears will try to take control and push the market down. But let's look at the US 100 futures, because this is where things got interesting. Anyone that had stop losses above here, sad face for them, they just lost their positions. And unfortunately, I'm sure somebody out there has a stop loss there that just got hit. Now the market rejected that area, and I've still got to watch reaction here for a reason. This area I'm incredibly interested in. We know that retail traders are trading big tech. You, me, everybody else, we're all in big tech for a reason, because we love that sector the most. And it tends to be the one that offers the most amount of manipulation. Now, if we scroll over to some previous times, you might notice there are other periods like this that have occurred during this rally, where we've had these incredible runs like, oh, it's all amazing. And then all of a sudden it just gets off. And then we've turned into distribution and things went bad. So we do need to be incredibly careful here of this current condition in this market. It's come up to a critical point, which we've had mentioned for a while. It's rejected it on the surface, and how it interacts with this zone, how markets, even if they rally again, how markets interact with this zone, I believe day traders and scalpers and other people will really be looking at that. Bears actually should commit right around these levels across most of the markets. So let's have a look at the SPY. On the surface, very big, strong close. Obviously, we had the close that was pretty strong bearish. We made the lower low, which I think is important. We came off this area, which some people are going to say is resistance becomes support. But I think this is a switch to the downtrend, actually. And you always expect markets to find these huge rallies and then usually sell off. And the reason it happens is to grab liquidity, to grab as many orders as possible. This is the fastest way markets can change trend. And when they change trend this way, they often want to get as much liquidity as possible. So this is the day, or these are the next couple of sessions here, how the market interacts with these doji zones here, these little doji candles. We know there's trade there. We know there's big trade there. There's not just small trade, there's big trade. It's a whole ecosystem amongst itself within the 4120, 4140 zone. And I posted over on Twitter a bit of a chart as well, if you're interested in taking a look at it, just so you can see kind of our interaction. Now, nothing is perfect in trading, so you need to remember that there's always percentages attached to everything. But this is the type of place that I expect bears to take control. Heavily traded area, comes up into the supply, takes out people's stop losses. The correct stop loss is probably somewhere around there. We have a miniature little supply above here. And of course, we've always maintained, unfortunately, if the bulls take control above 4180 and close the session, then more than likely, unless there's some really big switch, the bulls have taken control of the market. So this is still where bears should be pressuring in. And once it got past 40.94, which was in our previous video, we were very comfortable the markets will go here. It is very likely. So this move from here to here is very likely. This last little spike is certainly the question mark that was caused by Amazon, though. And we actually saw it take the highs on, remember, the Nasdaq. So there's a lot to actually like about this market and the next 24 hours and how it interacts. If you're a bull, then you're championing the idea that it keeps rallying up. If you're a bear, you need to see this thing fade, and it has to fade around these zones. So it could maybe wait one more day, but in general, I would want to see this thing sell off from these levels. And that's just the way I look at markets. And, you know, I think everything here has been, once we did all of these things, once we took this low, the initial sell from here is good. The movement up into here, obviously there's a tight stop loss kind of sell that you could have tried, and it looked like it was working, then failed. But once it got through that 40.94, to me, this was always the zone. And if you go back over the last video, you'll see that's exactly what I was talking about. And I still think this is where the bears take control of this market. There's a very rapid gain with very little pullbacks, just a big move. Let's take the percentages here from the low to the high. It's a 2.38%. And it's not like it's justified by Amazon earnings, because all of a sudden Amazon's down on the session, down 2% after hours. If we have a look here as well, I'm just going to read out some numbers. Apple, 2.84% up. Amazon, 4.61% up. Google, 3.75%. Microsoft, 3.2%. And NVIDIA up 1%. So really across this stuff, what we're seeing is a huge spike in tech stocks predominantly. They're really riding this thing. If we actually have a look at this as well, which we'll bring in, which is the CBOE one-day volatility index, we're starting to see that spike up as well over the last 24 hours. This will be something we discuss more, but it's new. So if you want to put it on your charts, VIX 1D, an interesting chart, starting to probably replace maybe the way we look at the VIX overall, thanks to these 0 DTE options. Let's move over to the Bitcoin market now. So Bitcoin is still hovering around this level. If we scroll into the timeframes here, we don't have too much evidence either way, unfortunately. If we were looking for bearish positions, I guess you'd probably be looking for something like this. That would be the best bearish position. There's nothing much else that I really have an opinion on, though. We had some amazing trades on Bitcoin, but at this point, I want to see more. I need more trade. And we just don't have a nice structure that I think is replicatable yet. So yeah, Bitcoin's at a pretty close to critical level. The way it interacts with something like the 30,400 would be the way that I would set alerts. And that's what a lot of trading is. It's about understanding when you have edge. You know, I don't know if I have edge in this current section of the market. However, if it comes up here and it interacts a certain way, then I'll have edge. Remember, it's not necessarily a prediction. You're just reacting to key levels that are critical. That's the difference between many great traders and just, you know, basically more beginners. It's not really, you could ask someone, what do you think is going to happen with that next week? Remember, Druckenmiller, one of the best traders of all time, Stanley Druckenmiller, he'll just say, I don't know, but I have these thought processes if these happens, and I could change my opinion next week. And that's a really good trader there. That's somebody that understands that he needs to keep an open opinion of the markets and be flexible in his approach. And you'll hear that from any big old timer in these markets that's traded billions. They all tell me the same thing. When I've spoken to them, I've been lucky enough to speak to some people. I hope one day to meet Stanley. That would be awesome. But yeah, look, whenever I talk to anybody that manages a significant sum, that's what they say. And I thought I might just give that tip of advice or tip of comment today in this video. What have we got coming up? Core PCE price index and the employment cost index. That's 8:30 a.m. New York time if you're interested. And do remember, if you enjoyed today's content, why not follow us on some of the other socials? Also, you can take advantage of some free trading cheat sheets. All you need to do is chuck your email in there and you'll get it. So why not give it a shot? Thanks so much for joining today's video, guys. Thanks for being the best community out there. I hope you have a great Friday in the markets. And look, let's see if these bears can take control. This is the supply that technically they should be having a go at. We'll find out whether they do. And it's all about having the patience to watch for them to actually show their hand. And that's what Wyckoff taught us about markets as well. We need to study force. All right, bye for now. Catch everybody.